is the smartest move to master the tax code or to quietly move your money where the tax code can't reach it? Should you master legal tax tricks or move your wealth beyond government reach? We compare two extremes, playing the tax system as a wealth tool versus escaping to cyberspace, and competing jurisdictions. Stay to learn when to squeeze your current system, when to shift offshore, and how a hybrid path secures real financial sovereignty. Are you losing decades of your life to taxes? Right now, you are probably giving your government 30 to 50% or more of everything you earn through income tax, sales tax, value-added tax, payroll tax, property tax, estate tax, and more. That means you are effectively working 3 to 4 months of every year just to feed the state, which can easily add up to around 20 years of your lifetime working only for taxes. On top of that, inflation quietly erodes your purchasing power and can push you into higher tax brackets, so you lose both to rising prices and to higher tax rates at the same time. From the perspective of the sovereign individual, this is not just inconvenient. It is a form of ongoing wealth confiscation enabled by the old industrial era logic of violence, where governments used territorial monopolies and control over banking and currency to skim a hidden wealth tax through inflation and compulsory taxes. When a government can print money and expand credit at will, every currency holder effectively pays a yearly fee as their money loses value. The wrong way to go about this is doing nothing. Imagine you work a regular high-income job in a developed country, never learn the tax rules, and leave all your money in local currency and standard bank accounts under your government's full control. You pay 40% in combined income and other taxes, plus you lose additional purchasing power to inflation and bracket creep, and you never question it because you think that's just how it is. After decades, you realize you've traded a big portion of your life for a standard of living that could have been dramatically higher if you had either used the tax system better or moved part of your wealth outside of it. What if, instead of accepting this, you turned the tax code into your personal wealth map? The methodology introduced in Tax-Free Wealth says your starting move is simple, except that the tax law is not mainly written to take your money. It is mostly written to save money for people who behave the way the government wants. In this view, the tax code is essentially a long list of incentives for entrepreneurs and investors, and only a very small fraction of it is actually about raising revenue. If you change your facts, how you earn, invest, and spend, you change your tax. Key principles from this book's ideology: taxes are your biggest single expense, often 25 to 35% of your life. The tax law is primarily a series of incentives, not punishments, rewarding you when you invest in business, real estate, energy, and agriculture the way the government wants. Almost every expense in your life has the potential to become a deductible business expense if you structure it correctly. The first practical takeaway is changing your role in the system. If you stay an employee only, you are structurally set up to be the full retail taxpayer and the government's best customer. The book argues that when you become an entrepreneur or an investor, even on a small scale, you move into the class the tax code was actually written to benefit, often cutting your tax burden by 10 to 40% permanently. Here are both the right and wrong ways to do things in one specific scenario. Wrong way is you earning $100,000 as an employee, spending it, and then trying to find deductions at year end. You pay full income tax, full payroll tax, and treat almost all your spending as personal and non-deductible. Right way, in tax-free wealth style, means you structure a small business or investment activity around things you already do, like consulting, content creation, or rentals. Now, when you travel to a location mainly to evaluate an investment or run your business, your airfare, hotel, and meals can become qualified business expenses. If the primary purpose is business, you spend more time on work than recreation, and you meet the detailed rules of your country's tax authority. You have not changed what you enjoy, you have changed your facts, so the same spending can legitimately lower your taxes. The second practical takeaway is turning taxes into a permanent cash flow raise. The book stresses that the fastest way to put money in your pocket is to reduce your taxes because that change hits your cash flow immediately through lower withholding or lower quarterly payments, not decades later. Every dollar you earn and every dollar you spend either increases or decreases your tax. Once you understand that, you can consistently choose structures that push spending into the deductible column. Example with concrete numbers. You invest $100,000 in stocks outside any planning and earn a 10% return. After capital gains tax, you might keep only $8,000. If you put that same $100,000 into a leveraged rental property, earn roughly $7,000 cash flow, and use depreciation to wipe out the taxable income, you can also create an additional $6,000 reduction in tax on your salary or business income. In real terms, that's a 13% effective return versus 8%. You've nearly doubled your results simply by changing the type of asset you own and the way it's treated for tax purposes. The third practical takeaway is using structures to block government at the inheritance stage. This book also treats estate planning as a way to prevent government from capturing your wealth at death through estate or inheritance taxes. It recommends putting major assets into trusts so your heirs avoid public expensive probate and reduce opportunities for predators. Using limited partnerships and discounts, minority and marketability discounts, to give away value while keeping control and pressing down the taxable value of your estate. Timing and structuring gifts so you use exemptions and keep appreciating assets like businesses and real estate outside your taxable estate. But what if, even after you master these rules, your government keeps inflating the currency and raising rates? Do you still want all your wealth trapped in one tax system? The sovereign individual takes a much more radical stance. It treats the modern tax system as historically temporary and technologically fragile because the core advantage of nation states, monopolizing violence in a specific territory, is being eroded by information technology. As more of your income and assets move into cyberspace, the authors argue that governments will find it harder to see, tax or freeze your wealth, especially when you can choose among hundreds of competing jurisdictions. Core ideas of this ideology, digital money and strong encryption, let you store and move wealth in a way that governments cannot easily inflate, seize or trace. Jurisdictions must compete for you like businesses. If taxes and regulations are too high, you can exit and domicile your income where service is better and taxes are lower. The welfare state model, where a large share of income is forcibly redistributed, carries serious long-term mathematical risks as demographics shift and high earners and capital become more mobile. The fourth practical takeaway here is using jurisdictional competition. The book explains how frontier-like march regions, historically these were border zones that offered low taxes to lure settlers away from powerful neighbors, once attracted people by offering almost no taxes, because if any overlord taxed too much, people simply switched allegiance to the competing ruler. It predicts a similar dynamic in cyberspace, where you can domicile your income-earning activities with service providers in different countries, making it difficult for territorial states to maintain a high-tax cartel. The right way versus wrong way in an international scenario could go like this. The wrong way to do things is that you earn high income in a high-tax welfare state, keep all your assets in domestic banks and the local currency, and let the government apply both inflation and high marginal tax rates to your wealth for decades. You ignore options to move, change citizenship, or alter where your digital income is booked. Instead, the escape the state method is that you intentionally earn in a global market and domicile your company or digital assets in low-tax or no-tax jurisdictions that enforce contracts but charge minimal tribute. You choose banks or digital money providers outside your home state's direct reach, reducing both visible taxable income and the state's ability to arbitrarily confiscate or inflate it away while staying within the law. The fifth practical takeaway is the shift from inflating currencies to hard or private money. The book emphasizes private encrypted currencies backed by assets like gold and describes how digital receipts for specific gold bars could circulate as money with almost no possibility of counterfeit or inflation. In this system, issuers must maintain the currency's value or lose customers, which sharply limits any hidden inflation tax. When applied, this means that instead of holding all your wealth in a national currency that your government can inflate, freeze, or surveil, you begin moving portions into harder assets and private digital representations of those assets. Your goal is to store value in forms that are resistant to both monetary debasement and easy seizure, while still allowing you to invest and transact globally. The sixth practical takeaway is to treat welfare state stress as a risk, not a prophecy. The book lays out a bleak but rational forecast. Commitments to pensions and medical promises in many welfare states may be mathematically difficult to sustain, especially if tax rates push too high and capital can easily move elsewhere. It argues that as more capital and high earners move into the cyber economy and low tax locations, those systems face rising pressure, which could mean higher taxes, reduced benefits, or both. The key here is not to assume an inevitable apocalypse, but to recognize a real structural risk. If you stay fully locked into one high-tax jurisdiction, counting on unfunded promises, you may be exposed if benefits are cut and taxes spike further. The escape method pushes you to gradually detach, first by moving income and assets, and eventually, where rational, considering changes in residence or even citizenship to align your obligations with more sustainable competitive jurisdictions. So now the real question becomes, should you optimize the system you're in or start exiting it, and in what order? When comparing these two approaches from tax-free wealth and the sovereign individual, at first this can sound like a hard choice. Fight inside the system or flee the system. But there is also a third path that blends the two, which we'll get to. First, let's put both books into the same concrete scenario. You are a high-earning, globally portable professional building wealth through business and investments, worried that your government is slowly stealing your time and capital. Scenario A, you follow tax-free wealth only, play the system, you stay in your current country, but you radically change your behavior. You create a business entity and stop treating yourself as just an employee. You start investing in rental real estate using depreciation and cost segregation to shelter your business and salary income. You turn your travel, education, and a portion of your lifestyle into business expenses by making sure they have a genuine business purpose, are ordinary in your industry, and are documented properly. You set up trusts and limited partnerships to move appreciating assets to your heirs and cut future estate taxes. As a result, your effective tax rate drops from, say, 40% to something closer to 20-25%, sometimes even lower. And your after-tax returns on every investment improve simply because you structure them to harvest incentives. You are still inside the nation-state system, but you are using its rules to legally keep far more of what you earn. Scenario B, you follow sovereign individual only. You treat your current country as just one option among many. You build businesses and income streams that operate through the internet, making your earning location flexible. You domicile your entities and banking in jurisdictions with low or zero income tax, strong protection of financial privacy, and legal recognition of digital signatures and cyber money. You store a larger share of your wealth in harder or private currencies that are resistant to inflation and centralized control. You gradually shift your physical residence so that your tax obligations are aligned with these more competitive jurisdictions. As a result, you can dramatically reduce your formal tax burden in your old country, sometimes to almost nothing, if you no longer meet its residency or nationality tax criteria, and your exposure to inflationary policies also drops as more of your wealth sits outside local currencies and banking systems. But there's a catch. You're trading tax simplicity for complexity risk. You'll need to navigate multiple legal systems, manage changing rules across borders, and accept that the exit is rarely free in terms of paperwork, costs, and potential scrutiny. Here's the direct methodological clash. Tax-free wealth says stay, but learn the rules better than anyone, because most of those rules were written to reward exactly the behavior you can choose to adopt as an entrepreneur and investor. Sovereign individual says, don't assume this system is stable or fair long-term. Use technology and jurisdictional competition to make the state a service provider you can leave, not a master you must obey. If you had to choose today which risk worries you more, Overpaying your government for the next 30 years, or getting caught on the wrong side of a stressed high-tax system in 20 years. For most viewers, the most rational path is not all in on either extreme, but a staged hybrid that uses tax-free wealth to maximize what you keep now, and the sovereign individual to design where your wealth ultimately lives and how exposed it is to any single state. A rational person views local tax planning as defense and jurisdictional diversification as offense. You don't start playing offense until your defense is solid. Stage 1, immediate. Play the system steps, meaning your defense inside your current country. You can start this month, shift from pure employee to at least some form of entrepreneur or investor, so you qualify for the tax incentives that dominate your country's tax code. Reclassify parts of your current life, meals, travel, education, home office, vehicles, as business-related where you genuinely can by aligning them with real income-producing activities and the specific rules in your jurisdiction. Use favored assets like rental real estate to shelter other income through depreciation, and in some systems, like-kind exchanges to avoid tax on growth when you swap properties. Begin basic estate planning with trusts and, where allowed, partnership structures to remove appreciating assets from your future taxable estate while retaining control. Stage 2 is comprised of the early escape the state moves, meaning your offense to lower exposure to one jurisdiction. As your wealth grows and your work becomes more location flexible, you can diversify where your income is legally booked by creating entities in tax competitive jurisdictions that genuinely host part of your activity. Increase your use of liquid assets and money forms that are less dependent on any one government's ability to inflate or seize, while still remaining within the law of your home country. Plan your potential future residence and citizenship options years in advance, understanding which country is tax based on citizenship, which based on residence, and how easy it is to exit their systems. There's a right and wrong way to adopt a hybrid approach. It's wrong to chase exotic offshore structures before you even know how to deduct your basic business expenses locally. You risk non-compliance, double taxation, and penalties while still paying high taxes domestically because you never learned the fundamentals. The right way is you first optimizing your local defense by squeezing every legal incentive out of your current tax code, build higher after-tax cash flow, and then use that stronger base to diversify your legal and financial footprint across multiple jurisdictions in a controlled, compliant way. The sharpened rational stance is that if your pain point is the check you have to write this April, follow tax-free wealth first. It's the immediate manual for stopping the bleed and turning your biggest expense into a lever for cash flow and wealth. If your pain point is the fear of where the world is headed in 20 years, the sovereign individual is your strategic compass. Use Wheelwright's book first to build the capital, then use the sovereign individual to decide where that capital is safest and least exposed to any one government's power. In other words, if your pain point is immediate wealth capture by the government, tax-free wealth is probably more practical for you today. But if your pain point is long-term sovereignty and safety of your capital over the next few decades, the strategic lens of the sovereign individual becomes increasingly important as your wealth and mobility grow. In the clash between playing the system and escaping the state, both books agree on one brutal reality. If you do nothing, the government will quietly claim a huge share of your money, your time, and your future by default. One path shows you how to legally pay far less tax right where you are by behaving like the entrepreneurs and investors the tax law is built to reward, while the other urges you to gradually withdraw your wealth and income from any single state's grip by using technology, harder money, and jurisdictional competition. For you, the decisive edge comes from combining them. You first build strong defense by stopping overpayment under your current rules. Then you start playing offense by shifting where your wealth lives so no single government can easily capture it again.